Should I constantly adjust my investment asset allocation for market changes? Imagine your investment portfolio as a garden. You plant different seeds like stocks, bonds, and cash. Over time, some plants grow faster than others. Should you keep trimming and changing your garden every time the weather shifts? Probably not. Most investors should stick with a plan called strategic asset allocation. This means setting a target mix of assets based on your risk comfort, how long you plan to invest, and your financial goals. Once you decide on this mix, you don't need to change it every time the market moves. Instead, you check in periodically to see if your investments are still aligned with your plan. Over time, some investments will grow faster, making your portfolio drift from your original target. When this happens, rebalancing is the way to go. It involves selling some of the investments that have grown too much and buying more of those that have fallen behind. This keeps your risk level steady and can even boost your returns by encouraging you to buy low and sell high. Trying to change your asset mix based on short-term market guesses is usually a bad idea. Markets tend to go through ups and downs, but they often bounce back over time. Making quick moves based on market news can lead to missed opportunities or selling at the worst moments. Most financial experts recommend rebalancing your portfolio once or twice a year. Some suggest doing it when your allocations drift by a certain percentage, like 5 or 10%. Doing it too often can cost you more in transaction fees and taxes, while waiting too long can expose you to more risk than you want. It's also smart to review your asset allocation when your life changes significantly. If you're nearing retirement, for example, you might want to shift towards safer investments. If your income or goals change, adjusting your plan gradually makes sense to stay on track. Some advanced investors use tactical asset allocation. This means making short-term changes to take advantage of market conditions. But this approach requires experience and active management. For most adults managing their own investments, sticking to a solid plan and rebalancing periodically works best. In the end, the key is to stay consistent with your long-term goals. Keep your portfolio aligned with your risk tolerance and financial needs. Regular reviews and rebalancing help you stay on course without reacting to every market fluctuation. This way, you can build a resilient investment plan that works for you over time.